So for those that joined early, I think you know what the topic is, but today the topic is right-sizing cyber insurance, and we're going to get started now. So for those of you that are here, and then we'll kind of do a wrap up at the back end. My name is Chris Hill. I'm the VP of Sales and Strategy for CyberSecOp. With me and our main presenter is Daniel Palmer. Daniel's an Associate Director of Brown and Brown and the National Cyber Team. So he's going to take the next 30 minutes, 25 minutes to sit down and talk to us about a really hot topic. Back when cyber insurance was kind of first invented, I think the cyber industry pretty much thought it was going to be like a windfall of free money and nothing was going to happen, and I'm insuring the improbable. And that clearly changed 3 or 4 years into it. And over the last couple years, the cyber industry has been getting a better handle on the actuary side of things, right? That's what they do for a living, is to sit down and kind of guess the probability of things to calculate the risks. And with the advent of AI, it's really complicated a lot of that as well, making some things really obvious, like phishing, where all of us used to be able to see a character that might have come from Czechoslovakia to know that that was false, and now those are so clean using AI. And one of the things that we do with our customers and is to sit down and make sure that in the process of assessing their cyber readiness, and that readiness is capability to protect and capability to recover, and cyber insurance is kind of over both, is do they have the right amount of cyber insurance? Do they have the right amount of coverage? Do they have the right amount of readiness? And if they have only one of seven things in place that a cyber insurance insurer is looking for, what that does to the policy or even potentially rejection. And that's the kind of stuff that Daniel's going to walk us through. So Daniel, thank you so much for the time. I hope you all enjoy this. There is a Q&A feature inside of Zoom. If you've got any questions along the way, I can articulate those back to Daniel, and we'll also open it up for questions through that app towards the end of the process as well. Thank you, Daniel.
Oh, thank you, Chris. I want to thank you for letting me be here today. I want to thank you all for attending, and thank you, CyberSecOp, for hosting me. As Chris stated, we're going to talk about right-sizing cyber insurance, and really what we're talking about is, are you carrying adequate limits? Are there any potential gaps within policies? What are the current pain points we're seeing in the claims handling processes? So to start out, we'll talk about cyber market update, and as Chris stated, cyber is a maturing line of coverage. It hasn't been around for decades like other lines have, and really was a throw-in coverage for a few years, heading back 20, 15 years ago. And then in around 2019, with an uptick in utilization of cryptocurrencies, we really started seeing claims rise as far as ransomware goes, and ransomware as a service became a profitable business model for threat actors. So we started seeing the industry experience heavy loss runs, which led to volatile pricing. Once pricing reached a certain point, carriers flooded the market with ample capacity, and we started to see a drop off of pricing. And now we're at a point where terms are really settling in. We're starting to see carriers push rate in some industries, but it's largely becoming a stabilized rate environment. There are still some higher hazard classes, and for various reasons, like healthcare has strong regulatory oversight. Manufacturing, if you're unable to produce product, you're not making any money. These coverages do include business income loss coverages, insuring agreements. Gaming, debt collectors, where there's high record counts and financial transfers, carriers see these as higher hazard industries. And then areas like municipalities, nonprofits, and schools, higher ed, where there may not be the budget to implement the minimum required cybersecurity standards. Carriers see that as higher hazard classes as well. So we're still seeing same, ransomware attacks. We're seeing compromised credentials as a result of the initial breaches, exploited vulnerabilities, which with the advent of AI, we're starting to see threat actors really attack these vulnerabilities at a much more rapid pace than we have seen in years past. So there's going to be ebbs and flows with whether, attackers or defenders have the advantage with the rollout of these AI tools. But right now, it looks like the bar or the barrier to entry has been lowered for cyber criminals, and the speed at which they can deploy malicious attack has ramped up. So now to talk about emerging threats, and really it's all focused, AI as far as ransomware goes, business email compromise, as Chris stated, the way that a threat actor in another nation state could write looks much closer to how someone in the United States might write now than it might have 20 years ago. You might have, some Cyrillic characters within an email address that may be the only thing misleading. So having, proper email controls and proper oversight of your network is becoming paramount. Now, the other thing we're starting to see is third-party vendors and supply chain attacks, figuring out how interconnected we are. So 2 years ago, there were two major claims that shook up the industry. One being Change Healthcare ransomware attack, and Change Healthcare is owned by United Healthcare, and it is a clearinghouse for about a third of medical claims within the United States. So having that great of an exposure, the billing process for claims, for medical claims, was just interrupted. We saw a lot of healthcare practitioners be unable to provide services. There were large business interruption claims, and it impacted a majority of healthcare providers since Change Healthcare handled so many claims. Another was CDK. Turns out about 80% of auto dealers were using the same software. So when CDK experienced a ransomware attack and an outage, the entire auto dealer industry was impacted by being unable to provide service, being unable to sell cars, and these costs were really impacted carriers' books who were over levered in the auto dealer space, which resulted in them pulling out of the market and price being adjusted for that. So that third party exposure is really what keeps a lot of carriers up at night. One attack leading to hundreds or thousands of claims.
I think one thing I'd like to add to it, and I think you're definitely touching on it, Daniel, but maybe the audience isn't. I just want to clear it a little bit. So on the screen you're seeing here, these are the main ways that the compromises or the attacks are coming in. What's pretty much shifted over the last 2 years was prior to that, it was about stealing PII data and selling it on the open market. Now it is a matter of stopping you from conducting business, stopping you from your manufacturing facilities to run, stopping you from accessing patient records so you're not able to care. So it's really, and in that way, the C-suite, whether it's the CFO or CEO or whatever, they actually understand how much every hour, every day costs. That's really where the threats are, or that's how now the threat actors are looking is how long can I shut you down? And that's the ransom calculation as opposed to selling data that is so plentiful in the marketplace right now. So in case I wasn't clear with what Daniel was saying, I want to make sure you guys kind of understand that that is the biggest thing, and I think you really touched on it in the automobile industry, not being able to sell, right, cars and do that kind of stuff.
So from a risk exposure perspective, you've got these cyber policies and you're probably currently carrying one. A recent study found that 27% of data breach claims and 24% of first-party claims had exclusions that resulted in either partial coverage or no coverage. And carriers are pointing to either exclusionary language, sublimit, pre-existing vulnerabilities that may have not been noted on an application. Maybe your application was completed incorrectly, but we're starting to see carriers deny coverage. So our goal as a broker is to put you in the best position possible by starting, from day one, reviewing what your controls are and putting you in a great situation to have your claim covered. And then I wanted to highlight these two headline events that happened. Asahi, which is a Japanese beer company, they experienced an OT outage, which left them unable to manufacture their product, therefore racking up millions of dollars in business income loss. JLR is Jaguar Land Rover. They actually didn't carry cyber coverage. They were UK, they're already, well, they're owned by Tata, which is an Indian company, but in the UK, uh, damages are uninsurable, so they didn't carry a cyber policy, even though there are other aspects of cyber policies, including first-party business income loss. So Jaguar Land Rover had to shut down manufacturing operations for months, which resulted in tens of millions of dollars of business income loss for Jaguar Land Rover. So where we want to start is just looking at the minimum security standards that carriers are looking for when you're submitting an application. And this hasn't changed much over the past few years, but really what we want to emphasize is operational resilience. So the main thing, multi-factor authentication, is the user who they say they are? We know that there have been, you probably get notified once a year, twice a year about your credentials being leaked on some Spotify, Target, some type of breach. A lot of people use the same business and personal credentials, passwords. So we want to make sure if someone's information has been compromised via data breach, that there is that secondary authentication control in place. And that's why multi-factor authentication is a minimum and required security standard for remote access, email access, cloud applications, backups. We want to see multi-factor authentication in place where it can be. Endpoint detection and response. This is a tool that monitors, identifies, and contains anomalous activity on the network on endpoints. So if I log in from Philadelphia today at noon and I log in from North Korea at 8 o'clock, the company may realize that something's up, isolate and contain any of my ability to move across the network and compromise data. Verified immutable backups. This is becoming a critical requirement for carriers, and it goes back to that operational resilience. We're seeing, we're talking about Jaguar Land Rover, but it's not just the big companies that are getting hit. Companies of all sizes are being hit with ransomware attacks, and it's happening with increased frequency. If you are unable to access data, how are you able to operate? Are you able to restore from backups? Do we know that those backups have not been compromised? How quickly can you restore from backups? And these are things carriers want to understand, when they're underwriting to each individual risk. Security awareness training, humans are part of the cybersecurity process. We're often the weakest link, so making sure that individuals are being made aware of what threats look like, what process they should take, how they should be using data, how they should be interacting with AI. Are they sharing company files to an open source AI feed? Or are they clicking on any, are they getting gift cards for the CEO? Those types of things. We want to make sure your employees are aware of what threats look like and what the company's processes are. And then patch management. So goes back to vulnerabilities, and we're starting to see if you've paid attention to Anthropic and what they've been publishing every 2 to 3 weeks. They've got a new model. It's dangerous. We can't let it out because it can identify vulnerabilities in your iPhone and the Microsoft Office suite. And so this is what the fear is for a lot of carriers is that tools like these will be able to identify vulnerabilities. You can go to the dark web, see where the vulnerabilities are, find a machine and an IP address that has this vulnerability on it, get code to execute on that IP address. And so carriers want to make sure that you have a patch management process. Are you patching critical vulnerabilities ad hoc or on a routine basis, maybe every 2 days, every 3 days? And what about non-critical vulnerabilities? How often are you patching that? We understand that, they do have these requirements, whether it's 7 days, 48 hours, ad hoc basis, that every company is different and you may not be able to patch your environments that quickly. But carriers want to make sure that you do have a cadence and a process in place for patch management.
And Daniel, on that other slide, I mean, I would assume that that the industry is sitting down and making coverage decisions, payments, premiums and all that are going to be based on how close to, let's call it perfect, each organization is on these 5 points that you've got there, right?
Yeah, and there are other controls. The applications are a little more in depth, but these are really the baseline controls that carriers are looking for every client to implement prior to placing coverage. And the reasons for that is, it really exposes carriers to large claims. It exposes clients and policyholders to large claims if they're not implementing these tools. It result in some severe downtime, uh, liability claims. We've seen there was Lehigh Valley Health Network had a data breach about a year and a half ago, and the settlement from that data breach was $65 million. So there can be pretty substantial settlements along with the business income loss, along with, retaining breach counsel, the forensics, the notification costs that are all baked into these policies, and that can result as or be the result of a malicious attack or a data breach. So how we as the broker right size the placement, what we want to understand is first we assess the risk. We want to understand, the injury or the industry. How do you make money? What kind of data are you collecting? What kind of regulatory bodies oversee that industry? What kind of technology you're using? Are you using operational technology or is it just IT? And then what about dependencies? Like I said, with CDK in the auto industry, are there these dependencies industry wide? Are you using the same softwares? Are you using the same vendors? If there is an outage, what does that look like from a macro perspective? We analyze the exposure. We run benchmarking and aggregate financial severity. We evaluate existing controls and we make recommendations for improvement, not just on the minimum security controls, but we can look deeper into email controls, other authentication processes, funds transfer requests, and then develop a strategy. Recommended limits based on that financial aggregate exposure, or is there a different coverage structure needed? Are there contractual requirements? Some industries, for instance, architects and engineers, you may see many firms have requirements to carry 10 million limits, 5 million limits, something that's specified by a contract. And we identify carrier fit. We want these to be worth more than the paper they're written on. So we want to place with carriers that are going to pay when there are claims because that's the point of insurance. Then we negotiate coverage. We look for where there may be gaps in coverage, improve terms and pricing, and then align that with your risk appetite and your budget. So looking at cyber insurance coverages, it's broken down into two parts. First party coverage is that business income loss, those expenses with breach response, forensics, notification, breach counsel, restoring data, breaking, which is restoring hardware that's been made rendered useless as a result of attack, reputational harm, even cybercrime, which is social engineering, fraudulent transfer requests. And so where we're seeing coverage denied in this space, so cybercrime, for instance, many policies, and we want to make you aware if this is the case, have requirements to verify any funds transfer requests. So if I call up and say, all right, I've changed my routing information to XYZ from ABC, are you emailing back the source that asked for that request that you have on record? Are you verifying via a secondary means? Where this language is in policies, we're typically asking carriers to remove the language, but that's not always the case. So you want to be aware of what the policy is requiring you to do. Next thing, non-IT provider coverage. So a lot of these policies, they're not all the same. They're not standard Accord policies. The language can be different policy to policy. So we want to understand what your exposure is from a non-IT provider perspective and whether the policy is offering that or not. So this coverage provides business income loss and extra expenses for an outage at a non-IT provider. Say you sell tires and Michelin experiences a ransomware attack that shuts down their manufacturing operations for 4 months. You're unable to sell their tires. What kind of income loss are you experiencing? Well, most policies are designed for that coverage to really only apply to IT providers. Is ADP down? Is your HR software down, resulting in a claim, or something like CDK that does servicing, purchasing, those kinds of software? So we want to make sure, we understand what your operations are to adequately procure a policy that's going to give you the coverage that you need as an organization. Another thing to look for on the cybercrime side is if you're a retailer, a lot of these policies, the trigger language will be a loss of monies or securities as a result of a funds transfer request. Well, if you are an art dealer and you sell a painting, that's not a loss of monies or securities. That is a tangible good. So we want to make sure coverage is extended to tangible goods if necessary. We've seen clients, widget manufacturers, a truck pulls off after a fraudulent request. Well, that's a loss of tangible goods and didn't trigger the cyber policy. So we have, looked at what the exposures are for companies that do have these exposures, and we make sure that the language is broad enough to cover what their true exposures are and not just setting the base language in stone. So how do we quantify the financial exposure? We use industry, location, revenue, and then record count. We could use other factors as well. We plug that into a Monte Carlo simulation using claims data provided by carriers. And what that does is it runs a simulation about 50,000 times to determine the determine the outcome of an event that has not yet occurred. And that's how we typically benchmark. Most clients transfer risk to about the 95th percentile, unless there's a contractual obligation or they have a lower risk tolerance. That's how risk is quantified. And it does take into account how much would be spent on business income loss, how much are you spending on retaining breach counsel, privacy claims, those types of things. And now looking at how underwriters determine what the capacity is and the pricing. So they'll look at industry. Like we said, some industries have more regulatory oversight. Maybe some industries have different exposures. So a cyber policy, it's a privacy policy, but it also contains a media insuring agreement. Many cyber policies do. This covers copyright infringement, defamation, slander. Well, if you're an advertising agency, carriers may be more willing or less willing to add that coverage in and pull it back. We'd be looking to fill that gap if there is a true gap there. And then ratable revenue, we want to understand what the organizational scale is. Think about it, how much revenue are you making daily? So actuaries can look at that and figure out what is the impact of a 1-day outage, what's the impact of a 2-week outage, a month outage. So they can accurately price out if there is a large business interruption claim, what does that look like? And then record count. I think stamps just increased to 82 cents per forever stamp. So if you have 1 million individuals who are impacted by a breach and each one needs to get a letter mailed out per state requirement, well, you're looking at almost $1 million there just in stamps, not the printing cost, not the data scrubbing cost, but record count is what carriers are taking into account to determine how large of what the data breach cost is going to look like, and then understand class action lawsuits following a data breach. We're starting to see, for the lack of better term, ambulance chasers, post data breach plaintiffs firms that are just out there putting together class actions as soon as a data breach is made public. And carriers fear these. They are becoming, plaintiffs firms are becoming quicker and quicker to put together these class action lawsuits. So that is how carriers are trying to understand from a macro level what your risk looks like. So that's all we have. Are there any questions just off of that information? I didn't see anything in the Q&A.
Yeah, go back one on the other page, Daniel. So the why you attended, right? So everything Daniel gave you is tremendous information on kind of the industry and the process and what they're really looking at. So what you'll receive probably on Monday is going to be an email from CyberSecOp and Brown to sit down and offer that free assessment. So what would you get in return based on everything that Daniel talked about? You're going to get a free written gap analysis, a side-by-side comparison of what you have now to what the recommendations would be if you were kind of looking at this fresh, which is what Brown's going to be looking at across 13 different coverage areas. You're going to have pure benchmarking against yourself versus others in your industry to understand limits and retention and pricing and all that kind of stuff. So you have a vibe of are you getting a good deal or not getting a good deal or where you should or could be. And then along with that, will be some coverage recommendations. So the process is really then, if you want to take that forward would be submitting your cyber insurance policy in a very secure environment, have that analyzed, provide the comparison, and then a report readout of that for about 30 minutes to sit down and kind of understand what everything that Daniel said and what I just kind of described as far as the process of that and deliverable. For those that have attended, there's no charge for that. So we wanted to offer that as an incentive for you to sit down and kind of take advantage of that. The best thing that happens is that you come back and say, we have the right amount of coverage. B&B sits down and goes, yep, you are where you should be based on your individual needs that Daniel went over on the slide, the previous one. You're good where you are from industry, or they've identified a gap. And now it's a conversation internally with leadership on what's it going to take to sit down and remediate that. And some of that remediation might be buying more coverage. Some of that might be on one of those previous slides. Do we have multi-factor everywhere? Are we doing backups as a good cadence? Are we patching quickly? That kind of stuff. So there be both things that are no cost changes as well as things that might be investments based on the outcome, but all that's not known until the process is done. Daniel, anything you want to add to what I kind of provided in the last minute or so?
No, I think you hit the nail on the head. We do come back, if we review a policy and we review an exposure, we think everything's in line, we will let you know. Occasionally we run into prospects or clients. I had a large internationally known museum come to us for a policy review about a month and a half ago, and their policy was very substandard. So it never hurts to have a second set of eyes look at the policies and let you know what the exposures are, what's happening within the market, where carriers are concerned, and what changes, if any, you should make to your policy.
With that, I want to thank everybody. Daniel, thank you so much. It was really informative. I hope all of you take advantage of this. And like I said, either tomorrow or Monday, you should see an email coming from CyberSecOp with Brown to offer this free assessment. We will also be sending out the transcript of this, the deck that Daniel's been providing, as well as the recording. So if you need to share that, you'll have all that information as well. So with that, thank you so much. Hope you join us for our next webinar. If you choose to do that, that one is actually next week, our final in the series of 4, and that one's on third-party risk management, which is one of the things that Daniel had pointed out as being a critical element of concern or comfort based on what an organization has as far as their readiness in that space. So thank you so much. Don't talk again. Have a great summer.